Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm joined by Alasdair Macleod, an expert on precious metals and sound money, head of research for Gold Money, and author of the Macleod Finance Substack. We're going to discuss recent massive deliveries of gold and silver on the COMEX, the catalysts he believes will send the gold price higher, why a rapidly rising yield on U.S. Treasuries is sending a warning signal for the economy, and a whole lot more. So without further ado, here's my conversation with Alasdair Macleod. Alasdair Macleod, great to have you back on the show. I want to start our conversation today with a broad question. It's the same question I asked all my guests to get an idea of where their head is at. You can take it wherever you'd like. I'd like to know what you think are the main themes and trends in financial markets and the economy that you think more investors should be paying attention to right now.
Okay, well, the one thing above all is interest rates. The market, which is comprised of Keynesians, I suppose, really, think that interest rates are completely under the control of the central banks. They're not. Interest rates are rising, and they're rising for two reasons. Firstly, governments are in debt traps, so that the level at which you fund government debt inevitably means higher yields. And the second thing is that with most economies stalling, in 2025, banks see increasing risk lending into the private sectors. Now, an individual bank can reduce its credit exposure, reduce its balance sheet, but it can only do that if another bank or other banks increase theirs. Unless, of course, you get non-performing loans, in which case debt gets written off and deposits on the other side also get written off. And the other thing, I suppose, is if banks themselves go bust, then their whole balance sheet is taken out of the credit system, disappears. The central banks will do whatever they can to ensure that the latter doesn't happen. And they will also try and ensure that bad debts in the economy don't happen enough to disrupt things, if you like, simply by trying to suppress interest rates. But it doesn't work. It's not going to work. Now, this is very important because the level of bond yields, if they're going to rise, they will undermine the credit bubble as a whole, and particularly equities. Equities will crash. And I think this is a very important point. So really, to answer your question, I think central to all this, central to the value of markets in 2025, is this interest rate outlook. And I have to say that people have got this entirely wrong. Now, having said that, you can see that if you look at the US Treasury 10-year, which we take, if you like, as the sort of marker for global bond markets, that's meant to be the risk-free. Risk-free, I mean, honestly, these guys have got no idea. But anyway, that's meant to be the risk-free bond. I can see the yield on that going over 5%. At the moment, it is rising. And if you look at the chart, actually, the chart's very interesting because you've got a golden cross underneath the yield, rising yield. So it's all going in the, in a bullish formation, which tells us that yields are going to rise. And so why would this be? Well, I think the answer actually is very, very simple. We have obviously a new president from sometime in January, can't remember quite when. And that new president says that tariffs are the most beautiful word. What he intends to do is, as much as possible, to replace income and corporation taxes, or at least reduce them, and compensate by raising tariffs. Now, raising tariffs, apart from the effect on the global economy, which will tip it into depression, quite frankly. This is Smoot-Hawley Mark II, potentially. Not only that, but you're going to see consumer prices in the United States rise. So what does the Fed do? The Fed can't reduce interest rates more than what it'll do this week. I mean, it's expected to do a cut this week. I mean, quite frankly, if I was Jay Powell, I'd say no, just sit on it for now. But so interest rates is the answer to your question. That is the thing we've got to watch. And I would say that if we see that US Treasury 10-year note yield go over, say, something like 4.75% to 5%, then alarm bells will be ringing very, very clearly. And I would suspect that it will be the end of the bubble, the end of the asset bubble. We'll take out equities. It'll also take out, and this is maybe controversial to a lot of your listeners, it'll also take out the crypto bubble, particularly Bitcoin. I can see that collapsing along with equities. Because apart from anything else, it correlates very, very nicely with NASDAQ. It's the same cohort who go for the Magnificent Seven. They're the guys who are also buying Bitcoin. And okay, Trump's bullying it up a bit with a few comments and all the rest of it. But as soon as he gets into office, it'll be made absolutely clear to him that you do not promote Bitcoin because all you do is undermine your own currency. So that's basically the answer to your question.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Well, let's dive a little bit deeper into this rising rates, rising yields on the 10-year US Treasury note and why this could be cause for concern, because you wrote an article about it on your Substack, which I recommend everybody check out, Macleod Finance. Could you maybe give us some more details on why exactly this is setting up to be perhaps something alarming? And what would be the aftermath should we see yields rise above 5%? You're saying that it could bring down a variety of asset classes, crypto market, equities, the bond market. In that situation, would precious metals be the only safe haven, the only shelter from the storm?
Well, basically, yes. Now, again, this is where market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a complete, there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so all central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been a credit bubble, the response from central banks has been to reduce interest rates sharply, to take the pressure off malinvestments, off the zombies, if you like, off banks which may be over leveraged for those conditions and face substantial, loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about, you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as, you read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. This is twice as big. I mean, when this bursts, it is going. I mean, there is nothing, absolutely nothing, any central bank can do about it, because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
You made a post on your Substack recently on massive COMEX deliveries since Thanksgiving, where you wrote, in the last 10 trading sessions on COMEX, 62 tons of gold have been stood for delivery and 1,303 tons of silver. What does this tell us? Break that down for us. What does it tell us?
Well, the figures are even bigger now. I mean, a few days have passed, and I thought I'd look at it before we came on air. And as of yesterday, since Thanksgiving, it's 69 tons of gold and 1,324 tons of silver. Now, obviously, we don't know for certain who is standing for delivery. It strikes me that there must be many parties involved. So who could it be? I mean, you can see that in America, the people who are bullish for gold are really in a very tiny minority. The other thing is that if you look at the exchange for physical numbers, they are actually very, very high, particularly in gold. Now, what that tells us is that it's effectively it's an arbitrage between COMEX futures and London forwards. The exchange for physical basically is you go out of COMEX. What you do is you go out of COMEX and you go into a forward in order to take delivery. Now, you don't necessarily take delivery, and it could be the other way. So we have no idea as to exactly what the position is in the exchange for physical. But when you get high numbers, you know there is something going on in those markets. And just to remind you, when we had the run up, I think it was 2020, late 2020, when gold first ran up to challenge new highs, 2070, something like that. There was a crisis in the exchange for physical, and deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out, because for every long there's a short. Okay, so it closes out. Or alternatively, you can take delivery. But because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone taking delivery now? Well, not everyone, but I mean, you can see that there are huge, huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of out of futures. So it's a bid only market in effect for physical. And the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. Um, if you go to, start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff. This is more than most countries' gold reserves, since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contracts so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary, extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold. But that has to be justified. It has to be justified by the fundamentals. And here we come back to the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit. This is the key point. And this is also very much what the People's Bank of China has been doing. And it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and bars out of the Shanghai Gold Exchange system, but they also run gold accounts at their banks. And with the People's Bank of China having reduced interest rates a little bit recently, the alternative attraction, which is bank deposits, the Chinese housewife will take out a 3-year deposit in order to maximize the interest return. That's all coming down. So, of course, on a relative basis, it makes gold a lot more attractive. And bear in mind also that any Chinese national trying to hedge out of his currency can only do it in gold, because he can't go and buy dollars, buy euros, buy Canadian dollars, whatever. Can't do that. So, gold is the only thing they can do. And of course, Russians now can go and buy gold. I mean, they can run a gold account at their banks. So this is a world which is moving towards gold while we've been moving away from it. I mean, we're asleep, if you like, while this is going on. So anyway, that I believe is what's going on. I mean, basically, we're getting to the point where there is so little gold in the West now. And of course, the next thing is that when people wake up in the West, say, "Oh, we better have some gold," they run out and buy ETFs. What's that going to do to prices? I mean, I think it's a one-way ticket.
Yeah, and meanwhile, people in the West are too busy buying Haktua Girls coin, which was another crypto rug pull, and all sorts of crazy meme coins, hoping to make a quick buck. over a short period of time. It's a completely different mindset, I think, than the Asians and the Chinese in particular, as you were pointing out, a more long-term game plan. Both, I think, the government and the people there tend to think longer term than your average Western investor. You were talking about heavy gold demand from Asia. Is the vast majority of that driven by China and people in China? Are there other countries in that region that are also standing for delivery here when it comes to gold, or taking gold into their possession to get out of credit, as you mentioned?
Yeah, well, Russia, obviously. I think that the public there are beginning to wake up to this. Egged on a little bit by comments from people like Sergei Glaziev and so on and so forth. Southeast Asia, very definitely, and some of the sort of Central European nations. I mean, Poland's been buying gold, and I mean, there's sort of countries which don't have much gold are having to go for it. Sorry, excuse me. And this also includes, of course, the Shanghai Cooperation Organization and BRICS communities. The central banks for these nations. Some of them have got gold. Some of them are heavy miners, like Kazakhstan. But so many others haven't got it, and particularly also not just the associates who were appointed to BRICS in the last meeting, but also those who would see their long-term future perhaps migrating from the Western financial system into, the sort of, if you like, the Russia-Chinese Asian axis. And lots of nations are in that position. I mean, they're sort of too frightened to move too suddenly, because they all owe dollars big time. And the other thing is that the experience of upsetting the Americans is that suddenly you find there's a regime change on you. So they are very cautious about the whole thing. And, I think this is also true of Saudi Arabia, incidentally. Saudi perhaps are also looking at this from the point of view that they don't want to disrupt the world order. I'm sure they've been talking to the Chinese about this, because that's the Chinese view. India has been accumulating gold as a nation. As a government, having eschewed it completely. While their citizens, annoyingly, as far as the government were concerned, were going out and buying gold. So they're all moving towards gold. I mean, a lot of them don't like the idea, but they recognize that things are changing. They recognize what this guy Zoltan Pozsar christened Bretton Woods 3. We're moving into a new monetary era, and it's an evolutionary process. But with gold mine output and scrap and all the rest of it, it's actually sort of quite limited in terms of, when everybody is trying to increase their gold reserves and get rid of their currency reserves, you've got to start thinking ahead. And I think this is what they're doing. And this is why there's just basically none available in the West. It's gone.
Now, I've had a number of guests on this show kind of sing the praises of silver at this point in time, saying how undervalued it is, complete bargain at this price. As a lot of people like to point out in the comments, the story of silver being undervalued has been going on for more than a decade at this point. Silver's had a good run over the last several years. I think a lot of people came into the silver space during the silver squeeze movement, and that was their entry point, was close to $30. So now they're thinking, silver can go to the moon from here. Are people's expectations just too high here? Is $30 silver fairly valued in your opinion?
I mean, silver has always been undervalued. I mean, talk to the bunker hunts. Back in the late 70s, early 80s, they tried to corner the market. They obviously came up with exactly the same conclusion. It's an interesting one, because silver has gone through quite a number of changes. There was a time when its major market was celluloid film, photography, whatever. But since then, things have changed hugely. And there is no doubt that demand for silver is enormous. Now, I think the question is not so much, implying, should we be bored of this story, but actually look at what the Silver Institute's numbers show, that it has been in supply deficit for the last 4 years. And the drawdown on it has been from what they call investment funds. Now, investment funds, all very well, but a lot of them aren't really investment funds. It's a sort of balance figure, which is an assessment, if you like, by the Silver Institute, to make the numbers, on the sort of supply side and the demand side and the deficit. Okay, we've got a deficit. So what we've got to do is we've got to pencil in a number somewhere which will cover it. So you can see that to some extent the number is made up. But I mean, after 4 years, and not only that, but I mean, in this country, we've got lunatics in government who are trying to carpet the country with solar cells. This demand is not going to go away. And one of the other things, actually, going back to COMEX deliveries on the silver side, is that the Indian government decided, it needed to do something nice and, ESG friendly, whatever. Stop criticism from G20 fellow members. So they said, right, okay, what we'll do is we will subsidize the production of photovoltaic cells. Okay, so what happens is that the big Indian conglomerates then set up manufacturing facilities, like I think Reliance Industries, which is one of the big ones. Sort of looking to produce something like, I don't know, 20 gigawatts of photovoltaic cell, output. The sort of however many units that is. I mean, just huge. Again, carpeting in India with these things. But where do they get the silver? They haven't got any help. Oh, good idea. I tell you what, we can go and raid the markets, the Western markets. So, as I say, 1,324 tons have disappeared on standing for delivery. Now, I don't think it's actually necessarily gone out of the vaults yet, but I would suspect that this is all part and parcel of the shortage of silver around. And again, let's put it this way: if you're a manufacturer of photovoltaic cells or whatever, and you have been prescient enough to accumulate a stock of silver, which you must have, okay, assuming you've been prescient enough to do that, then when you see the price rise, are you going to try and sell some to push the price down a little bit? Are you hellers like you're going to hang on to your silver, so tight it's not going to go anywhere near the markets? Now, these balances are basically what the Silver Institute tell us are the swing factor, which has stopped silver prices going to the moon by these people supplying the market to make up for the shortfall. There comes a point, Jesse, where this no longer happens. There comes a point where suddenly you find that, say, the supplies are not made available. And not only are the supplies not made available, but you find that those pesky people in the markets go and subscribe for physical ETFs. And we need this like a hole in the head because there isn't any silver. So, and they will be playing games. I mean, this is one reason, I'm not actually all that keen on ETFs because you don't have ownership of it. I mean, it's far better that, if you want silver, have the coins, have the bars in your own possession. If you have it in an ETF, I think someone's going to dip their hands in it one way or the other. And you find that you rather wish you'd actually gone for the real stuff. But the point is that there are huge shortages developing in silver. So the idea, I mean, I can also another way to look at your comment, the number of times, in my nefarious career where I have bought into, say, a mining stock or something like that, And I got impatient with the bloody thing. I've been sitting on it for 2 years and it hasn't moved. And all the good news comes out. We discovered this. We got another, we got a sort of grades of 15 grams per ton, or all this sort of stuff comes out. Oh no, price doesn't move. So eventually I sell it. Then what happens? It goes to the moon. so, so I think I don't give investment advice, but I think this is one where patience is still required, and I don't think it'll be another 40 years, rather like the bunker hunts I've unfortunately found. Because it hit 50 then. They drove it up to 50 back in, I can't remember whether it was 79 or 80. I mean, I remember that well because I had a client who was a very wealthy Austrian industrialist. And this guy, he liked to sell options. In other words, this is really against mining stocks and mining finance houses and all the rest of it. And fortunately, I had no positions at all when the bunker hunts decided to hit the silver market. And friends of mine in the commodity market who were dealing with him found he was short and they went bust. I mean, the brokers went bust on it, which was very, very unfortunate because this chap found that silver moved more in one day than it had in the whole of the previous year. So be patient. Be patient is the answer.
I want to switch to the realm of geopolitics for a moment because a lot has been happening recently. We've seen the fall of the Assad regime in Syria only to be replaced by a wanted terrorist as the new leader. I think the West is trying to spin him as some kind of friendly face all of a sudden. Now, Israel also bombing the hell out of Syria in the aftermath of that. We've seen an escalation in terms of Ukraine's aggression towards striking Russian territory, the US seeming to get more deeply involved there. The list basically goes on. What are you most concerned about? Does this sort of geopolitical risk play at all in terms of, the risk premium on gold or silver as a safe haven asset? Do you think it could drive the gold or silver markets in any way?
I don't think it does, really. No, I don't think it does. Yeah, I mean, Syria was sort of rather sudden, wasn't it? And this leader of HTS has tidied up his beard from his jihad days, and now looks presentable. You sort of get the feeling that somebody has sort of primed him for this role. Syria. I'm afraid the story there hasn't ended. There's so many factions. You got the Israelis trying to capture the whole of the south. Golan Heights and all the rest of it on going north. You've got the Turks, you've got the Kurds, who the Turks hate. You've got the Americans stealing all the oil, in the northeast. And you've got tribal conflicts. You've got the Russians with the port. I mean, there's so many factions now. I mean, I just think that the country is likely to disintegrate in a similar way to Libya after Gaddafi was overthrown. So that's not good. I think that what's going on really with Ukraine is it appears to me, and I can't find any other explanation, but it appears to me that the Biden administration is just trying to make things worse for the incoming president. They're basically just ramping the thing up. I mean, it's a lost cause. Ukrainians are losing. And you can detect this in Zelensky's manner too. I mean, he's talking now about negotiations and so on, whereas before he wasn't. There was no way. I mean, he tried to negotiate earlier, and we stopped it, which I think was unconscionable. I think that was terrible. Think of all the Ukrainian lives that have been lost since. And for what? I mean, we believe the Russians want to take over the world. I mean, it's complete nonsense. It flies in the face of the facts, and we are being given propaganda, if you like. Anyway, enough of this ranting and raving on my part. I think the point, as to your question, is that I don't see this really affecting gold and silver, except if we get to the point where and this would be particularly, I think, on the economic side, sanctions against Russia, attacks against Russia, if you like, get to the point where Russia decides that it's got to trigger the nuclear, the financial equivalent of a nuclear bomb. And we're nowhere near there yet. Because if Russia said, right, we're going to put the ruble on a gold standard to protect the ruble, which actually is very sensible. I mean, I don't know how many people have noticed, but recently it's been very weak. It went down from around about 90 odd to the dollar to 115 all of a sudden. And they've got interest rates running at 21%. And, there's talk it might even go higher. But actually, the Russian economy is in extremely good health. I mean, it's the extraordinary thing. Putin could put the ruble on a gold standard very, very easily and keep it there. And going back to my point about the function of an interest rate is to manage the gold reserves, he starts from a point of 21% overnight money in the Bank of Russia. Gold on COMEX or wherever, if you can find it, least yields what, 1.5%, something like that. So if you can get it at 1.5%, ship it over to Moscow, knock on the door of the central bank and say, here's some gold, give me rubles, please, because the rubles will be a gold substitute, make no mistake. Then you've got an uplift of, sort of 19, 20% on your money, just on a round trip. I mean, what's not like, this is the point. This is why interest rates are so important. What would then happen once it becomes established? I mean, okay, you wouldn't find any Western bank doing this. Apart from anything else, governments would lean on them not to. But you would certainly find the Russian banks. You would certainly find some of the Chinese banks doing it. You would find other banks around Asia doing this too, because it's money for old rope. It really is. Money for gold, if you like. Gold, anyway. So that, I think, would actually undermine the entire Western fiat currency system if Russia did that, which is why I would say it's the, if you like, the financial equivalent of a nuclear attack on us. It would be extremely serious. This is, I'm pretty sure, understood actually throughout Asia, because China and India stopped the move towards a BRICS currency with some sort of gold backing, whatever. Didn't want it. And I'm sure that the reason for this is that they didn't want to undermine the global financial system. It's not the Chinese approach. The Chinese let us make all the mistakes. So they just sit there and get the benefit. They don't actually go out and attack us. So Russia's move with BRICS, which was launched bizarrely through the Russian embassy in Nairobi, ahead of the Johannesburg meeting, I think in July that year, it was stillborn. It never made the agenda because the other BRICS members weren't going to put it on. So Russia on her own, I think, will do it. I think they will go on to a gold standard. And assuming that they don't do it as a deliberate act of financial war, I think that they will do it along with China to protect their own currencies from a collapse in our currencies, which brings us back to the consequences of higher interest rates and how it destabilizes our financial markets and pops the biggest bubble we've ever seen in economic history.
I wonder if you have any thoughts on my home country of Canada, what's happening there right now. The finance minister resigning. The Canadian dollar has recently hit 21-year lows on a monthly basis versus the US dollar. The economy is in shambles. I mean, I go back and visit Canada every year, and I'm always shocked at the prices. I'm guessing in the UK prices are quite high as well. In a lot of the Western world, there's been a lot of price inflation. Trump also threatening 25% tariffs against Canada if they don't get their act together regarding the border. And to top it all off, they have zero stated gold reserves. What are your thoughts on what's happening in Canada right now, the Canadian dollar, and the fact that they don't have any gold?
I mean, the thing that surprises me is that the 10-year loony bond, if that's what you call it, only yields about 3.2%. I mean, it's crazy. It's completely mispriced. It really is. In Canada's favour as a G7 nation, I think it's got a government debt to GDP of around about 70%, which is high. I mean, don't get me wrong on that. But when the other G7 countries, with the exception of Germany, are all looking at 100% and plus, and with America 130%, you know, it's relatively, I mean, well, relatively something rather. Um, Normally, when a finance minister resigns, currency gets undermined. I mean, it's quite simple. The last thing a finance minister should do is resign, for the very simple reason that it just undermine the currency. It would drive up interest rates. Um, you know, it would just signal to any foreign holder of the Canadian dollar that this is a bad situation getting worse. So um, I think it's terribly sad actually that the current government has made such a mess of everything. And I guess next elections there will be a huge, great change of government. We'll just wait to see whether they're any better. Jordan Peterson seems to think that the Conservatives have got their act together. So, but time will tell.
Yes, yes, it certainly will. I think for me, the People's Party of Canada is the only one that at least seems to speak out against the debt and deficits, speak out against, the ridiculous restrictions that went on in Canada during the pandemic, the destruction of the Charter of Rights that took place when people who didn't take a medical intervention were stopped from leaving the country. It's a very interesting pivot that the Conservatives took because they were fully on board with everything until the Freedom Convoy protest happened and until I think they realized, wait, there's this big portion of the population that's not happy with all these things. So let's differentiate ourselves by pivoting in that direction. Now we're all for the Freedom Convoy. We're all for, this type of thing when before it wasn't that. So it could be a lot of political posturing. We'll see what happens there. The People's Party of Canada is massively fringe. They will not get into power anytime in the foreseeable future, which is unfortunate. But yeah, some very interesting thoughts from you today, Alasdair. Very much appreciated the conversation. Can you tell us about the Macleod Finance Substack, what it is you do there, where people can find it?
Yeah, I set it up basically because I could see these events unfolding, and I thought there was a role for someone to educate ordinary people about what's happening, so that they can take whatever measures they see fit to protect themselves. So it's if you like an educational Substack in that sense, but it's also a channel for information. Sort of broadcast like this, Jesse. I put up, and it helps, if you like, inform people about these problems. Now, not everybody will necessarily agree with it, but I think my audience, if you like, is far wider than I ever had at Gold Money. I mean, Gold Money was basically preaching to the converted. So this is, if you like, an attempt to just broaden knowledge amongst the widest possible number of people. Because if we get a collapse in the value of credit, which is, I think it's a problem that is accelerating, is going to harm everybody. I mean, even those of us who, bought gold, silver, whatever, and think we're protected. This is not going to be good because it's not just us, it's our relatives, families, community, whatever. That we're going to live through a very, very difficult time. And I think the more knowledge that people have ahead of the event, then hopefully, we can take some sort of remedial action. We can understand what's going on and therefore sidestep some of the worst consequences.
Well, I'll put a link in the description below to the Macleod Finance Substack. Always appreciate chatting with you, Alasdair. It's been a fantastic conversation, and thank you for sharing your knowledge with the audience once again.
Thank you for having me on, Jesse.
Thank you for joining us today. This episode was brought to you by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.